Have you ever wanted to know how some of the wealthiest people save their time and make it grow every time? Well, if you were ever like me, then you know just how frustrating it is to get money and having to spend it immediately on things like bills and savings. Thankfully today, we have things like index funds. But you might be asking, what in the world are those? To that I say, it's something life-changing. Did you know if you save $200 per month at an 8% annual return in 45 years, you would have over, drumroll please, $1 million? To be honest, when someone first explained this was possible by investing in index funds, I hardly understood a word they were saying. It was like they were speaking a completely different language. But I thought that it was maybe about time I let others know about how I understood it and tried to explain everything step by step. Before we begin though, just a quick disclaimer, I am not by any means a financial advisor. I simply do my research and converse with the experts. These are just some of the real-life strategies that helped me in the long run. Through these investments alone, you might actually have a chance to be a millionaire. Welcome to Modern Wealth, where we help you be financially secure and stable. I'll be talking about 4 main parts that you should always keep an eye out for. So part 1 is uncovering the lies. Let's cut to the chase. You've been put at a major disadvantage. People have been telling you lies about investing all your life. For instance, at school when I was growing up, I remember asking my teachers about investing, and they always said it's just for rich people, because only they can afford to hire professionals to do it for them. And for the longest time, I believed investing wasn't for me because I wasn't a pro, and I didn't have much money, so I thought I wouldn't stand a chance. Some of my own friends even doubted me at one point. One friend that I know said I'd have to look at all the financial newspapers and learn how to read the charts, and according to him, it just wasn't worth my time and effort. On top of all this, every time I mentioned investment to my family, they seemed so scared because they thought it was the riskiest thing in the world, and not for ordinary people. My own flesh and blood was telling me that if I started investing, I'd lose all my money. Can you believe that? Well, these lies are exactly what the experts want you to believe, as they know that index fund investing is extremely easy to do. You don't need much money to start, the risks are pretty low, and on average, it will make you more money in the long term. The dark truth, however, is that the average actively managed fund returns 2% less a year than the market in general. This means that professionals on average are doing worse than index funds, and even if they end up losing your money, they still charge you fees no matter what. Always remember to be more perceptive to the truth. Now we move on to part 2, understanding the game. I remember when I first started investing, I felt like I was going to make so many mistakes. But once you understand that language, it all becomes so much easier. And that's what we're going to be talking about in this part. I've been going on and on about index funds in some of my videos, so this shouldn't really be huge news or new information. Let's take the S&P 500 for example. This is a list of the 500 best performing public companies in the USA, with the big dogs being Amazon, Google, Apple, and more recently, Tesla. And just like in sports elimination rounds, if a company doesn't perform well, they're at risk of being removed from the list. Although I have to admit, the idea of an index fund is to be a little bit sneaky as it allows you to invest in every single company on the list with just one click. It's a bit like a friend of mine who picks a different football team each year. He just wants to pick the winner every time and rub it all in our faces. But anyway, investing in index funds means that even if a few companies do terribly, then it's balanced out by the companies that are doing extremely well. The average return on the S&P 500 over the last 10 years has been 13.6%. Now that is higher than usual. But get this, no one has ever lost any money if they've bought and held an S&P 500 index fund for more than 20 years. So if this is so foolproof, then why do people still buy individual stocks? Well, personally, I like to do this just for fun. I also think that some companies are currently working on awesome technology for the future, but aren't making a lot of money at the moment, so they won't make the cut into the popular index funds. That being said, I'd like to invest some extra money into these up-and-coming companies, so I don't miss out. These seem like genuine people, and I wholeheartedly support them. You'll often hear people throwing around the terms Roth IRA in the USA stocks and shares, ISA in the UK, TFSA in Canada, and Supers in Australia. But what does it all mean? Well, these are types of accounts that allow you to earn profits on your investments, and you don't have to pay any taxes on them. But they generally have limits because they're just so powerful. So treat this information like a shield that will protect you. Make sure to use them only when you're investing. A way you can do this is by using the money inside your shielded account to invest into index funds. In no time, all the profits will be yours because the government won't take a cut. Now that we've gotten through 2 strategies, make sure to like and subscribe. You'd really be helping the channel out. But make sure to stick to the end of the video for a few more surprises. Now, back to the video. One of the biggest questions I asked when I first started was, should I invest all my money at the same time, or do I do it gradually? Now, this is something lots of investors argue and talk about a lot, but I'll let you peek into my insights a little bit. I do think that investing all your money as a lump sum is certainly riskier. However, if I'm investing in something that I know will increase over time, like an S&P 500 index fund, then there's no point in waiting. Truthfully, the longer you wait, the worse off you'll be. However, if you don't have the cash, I couldn't recommend waiting to save up the money. I would just invest what I could every month. Just remember that sometimes you're going to buy when a stock's high, and other times you're going to buy when the stock's low. But overall, this is going to balance out, and this is known as dollar cost averaging. When you log onto an investing website or app, you'll see that there is something called ETFs, which are very similar to index funds, and a lot of people get them confused. Both allow you to invest in a basket of stocks. However, the easy way to remember the difference is just to think of what ETF stands for: Exchange Traded Fund. If we simplify that, it just means that it can be traded on the stock market throughout the day, whereas an index fund can only be bought and sold for a price that is set at the end of each trading day. But let's cut to the chase. You probably want to know which one's better. On average, if you're starting with only a small amount of money, then ETFs may be a better option, as they have lower minimum investment thresholds and many brokers don't charge a trading commission. Most young people wouldn't know of things like this, but if you're young and you've been following so far, then kudos. Truthfully, you can start investing under 18. A lot of schools and parents don't teach this, but I will. The trick is to open up a custodial account in the USA or a junior stocks and shares ISA in the UK. To set up these accounts, you just need to ask your parents. However, the real secret ingredient to this millionaire formula is time. And when you're younger, you have so much of it. That's because every year as you keep adding to your investments, the interest starts to compound and grow at a rapid pace. It has this sort of snowball effect. Once you reach a certain tipping point, the interest you're making is much more than the amount you're investing on a monthly basis. It's a bit like when you see someone take ages to get to 100,000 subscribers on YouTube, and then just within a few months, they manage to hit the big million. Like most good things, the sooner you get started, the better, since time will be on your side. Now I want to clear something up. When people talk about index funds, you will hear S&P 500 again and again, and for good reasons. People just love it. But as I mentioned before, this consists of the top 500 public companies in the USA. The cool thing is, you don't actually have to be in the USA to invest in this. You could be in the UK or Timbuktu and it's still a great investment. I just love to think that I own a small part of all the biggest companies in the USA. Moving on to part 3, we have mastering the strategy. So a lot of people will teach and tell you what to do, but they won't actually show you how to do it. So I'm going to walk you through everything right now. The first thing to really do is to work out your aims. Let's say, for example, you want to become a millionaire. Easy enough, that was one of my goals. The hard part was to work out how much I would actually need to invest per month to achieve this. But to be honest, it wasn't even that difficult because of compound interest calculators. I can't stress how much I love these calculators. You can find them online, easily yourself if you want to try this. So if you're able to invest $250 per month with an 8% annual return over 42 years, you'll have over $1 million in your account. And if you're able to invest that for another 10 years, you'll have over $2 million in your account. Of course, if you wanted to invest even more, then you're just going to speed up the whole process. Now the next thing we need to do is pick the brokerage website we're using to set up our account and invest. The ones that I love and highly recommend are Fidelity, Vanguard, and Charles Schwab. I call these the Big Three. Funnily enough, the founder of Vanguard, John Bogle, is often referred to as the father of index fund investing. His Vanguard group gave birth to index funds, so they're considered the oldest and most trusted. Let's jump onto their website to see what they have to offer. So to get onto their full list of funds, just go up to Investing and click on Vanguard Mutual Funds. At this point, I'm going to have to ask you to strap in and brace yourself, because if you haven't seen this page before, it can look extremely overwhelming. But in just a minute, you'll be able to impress all your friends when you know exactly how to read it. I mean, look at this! There are just so many options. The main thing to focus on, though, is the expense ratio, which is how much they're going to charge you per year. You want to keep these as low as possible. And luckily, with Vanguard fees, these are really low anyway. Before we move on to the very last strategy, I'd love to know what you think. Do you think these real-life strategies are something you can do? Or maybe I missed something? Be sure to comment down below. So the last thing to look at is the average returns. It's always good to remember that past performance doesn't always mean future returns. Generally, there are 4 categories for the returns you should be looking at. Category 1 is bonds. These are a type of contract that companies and governments sell when they need extra money. If you invest in these, they promise to pay you back in the future. These are often seen as pretty low risk, but also pretty low returns. Therefore, the older you are, the more bonds you should have in your portfolio. Category 2 is balanced funds. The idea of these is to pick the age at which you wish to retire, and they'll do all of the rest of the work for you. They even find the right mix of index funds. These usually go up in 5-year intervals, and you can pick whichever suits your plans best. This could be a really good option if you wanted to invest without thinking about it too much. Personally, I always prefer manually investing, but of course, to each their own. Always go with what you're most comfortable with. Category 3 is company location and size, known as small, medium, and large cap. Here, you can find VFIAX, which tracks our old friend the S&P 500. This little s means it's one of Vanguard's selected funds, which they highly recommend. If you hover or click on it, you're able to see exactly what companies you would be investing in, and also the amount of risk. VTSAX is another good one, which is a total stock market index fund, which has over 3,586 different stocks. This allows you to invest in the entire USA stock market in just one click. There's a minimum investment of $3,000 again, but like before, there's also an ETF version with no minimum called VTI. But what if I told you there was another option? That other option would actually be international stocks. One really cool one is emerging markets, which invest in companies based in China, Taiwan, India, and many more. As you can see though, this is a 5 on the risk scale. That's why I wouldn't personally invest a lot of money into this fund, since I don't usually have the time of day and because I'd like to sleep soundly at night. Lastly, category number 4 is sector-based. So if you have a particular interest in energy, healthcare, or real estate, you can invest in these sectors. But there are also a lot more options for sector investing in the ETF. So now we've broken down what's an offer. Hopefully it all looks a bit more understandable. I would say probably about 70% American and 10% in some bonds. I like to keep the bonds quite low, but that's honestly a personal choice, depending on your risk tolerance. As a little food for thought, just remember that the funds that are available are different in every country, but the index they track are very similar. And if you invest in index funds like the S&P 500, you technically own a small piece of the biggest companies like HSBC, BP, and Unilever. Plus, if you work on bonds and other average returns, you have those to balance out your portfolio. A lot of sites are extremely helpful and make just it as easy as snapping your fingers. If you found this video helpful, make sure to like and subscribe. Thanks for watching, and if you want to learn a few more tips and tricks to handling your money or your money-making skills, make sure to subscribe. We'll see you in the next video. Cheers!